Good morning, ladies and gentlemen. I'll try to keep this brief as it's a holiday weekend and also because nearly everything closed exactly where it started the week. Equity's a little bit better, but really no change in anything that matters. The risk dials are still stuck at modest risk on, and every other chart of risk seems to be in exactly the same position. As much as I think that we are about to approach a period of risk off, there are absolutely no technical signs of it as yet. So one has to be mindful of that, and that I could be completely wrong. So let's go through some risk charts and see what the real situation is. As we look through these risk charts, let's remind ourselves what the macro narrative would be for a risk off at this time. You're talking about Doge cutting the deficit, which cuts growth. You're talking and liquidity, and then you're talking about 250,000 bureaucrats being laid off. Yes, they get a very nice severance package, which lasts about 9 months, but that's 250,000 people off payrolls, and they have to find jobs. So you're talking about quite a bit of hit to consumption, possibly, and we might have seen the first signs of it last Friday, or rather this Friday, when we had the retail sales number, which missed by a lot. I guess my theory would be that once you realize that you're about to lose your job, whether it's going to be next week or in a month's time, you tend to cut consumption. And 250,000 bureaucrats are going to be laid off, it seems. And in the meantime, what is going to replace those jobs? Well, nothing. And the budget deficit will be cut slightly, and therefore there's less liquidity, and you would have thought that'd be a hit to growth. Now, it's not manifesting in the charts. This is SPY TLT, but whichever you look at, SPY over SHI, SPY over IEI, SPY over IEF, it's all the same. And then if you look at the aggregate, which is ITOT over government, so that's the totality of the stock market, over the totality of the bond market, you get this. I think this level, this 562 level, whatever it might mean, is the really important level, because if you look at it, this is where we broke on the election of Donald Trump. So this is all speculation that he gets elected, this is he gets elected, and that we've been in a range ever since then. If we start falling through it, then that is significant to me, because everything that happened since the election is actually risk off. Now, the other news that we got were about reciprocal tariffs, and I guess the market breathed a sigh of relief, because A, reciprocal tariffs are a good story, and B, nothing is going to happen until April, so there is room and time for negotiations between different parties. The bit I don't understand is how he can treat VAT as a tariff. Well, VAT is not a tariff, but if he does choose to say, okay, the 20% VAT, that's, let's say the average in the European Union, is a tariff, that means that either he wants the European Union to completely change its tax system, which is impossible, or he wants to impose 20% tariffs on Europe. That in itself, I would have thought, is A, inflationary in the US, but B, hugely deflationary in the EU. And when I say inflation in the US, it's a first hit. It's not permanent, it's a first hit. So I just don't see how you can be short of European bonds, because it just doesn't make any sense. So because their growth is really going to be hit, but in the meantime you're getting a huge squeeze in European equities, and I guess that has to end first before all the other equity markets can look to stop and reverse. I am not going to be doing anything in terms of risk off until I see these charts turn, and they're just not turning. There aren't any components which tell me that we are in a technical situation where risk off can happen in the very near future. The bond market had one of those weeks which really tell you nothing at all. This is the 2-year note, and we closed within 1 basis point of, let's call it 2 basis points of where we opened the week. The CPI was hot, its components were hot. The next day we get PPI with cold components that go into the PCE, and therefore PCE actually is likely to be unchanged or even lower than it was in December. So the market comes back, and on Friday we have retail sales weak, and therefore the market closes the week very much where it opened it, kind of thing. I think the 2-year note is now completely stuck, because the Fed is going to be stuck for at least a couple of meetings. Why do I think it's a couple of meetings? Because we are not going to have enough inflation data that it's going to enable them to make a decision as to if inflation is actually accelerating or not. We would need to get really weak employment figures or other real growth figures that really crash for them to be able to confidently say that inflation is not accelerating, and therefore that they can cut, let's say, at the second meeting. March is definitely off the table, and therefore the 2-year note, how far below Fed funds can it go? General collateral is up here, 433, 435, and as you can see, every time it gets there, people are still willing to buy it and really saying, I will fund it for 0, because I still think the Fed is going to cut at least once or twice in this cycle. To me, that is very short-sighted. I think that all that the 2-year note is going to be able to do is basically anchor the curve. So if weak data comes out, the 2-year note is going to do very little better, and the longer end is going to do better, and therefore the curve gets flatter. And if really strong data comes out, the 2-year note doesn't go higher than 442, but the others go a little bit more, and the yield curve steepens. So this, to me, from now on, is an anchor. The 5-year note as well, below general collateral, why would you really want to buy it? To me, every time it gets to 427, it's really going to struggle to maintain it, unless you keep on getting weak numbers. You can see how important this 427 level is. Every time it gets there, it struggles. I think that this is just a pointless contract to trade now, unless it's on a spread. The 10s and 30s are really not all that much better, certainly in the 10s. I think that you could possibly get them to general collateral 435, 430, but I think it's far more likely to trade around this 458 level for quite some time. And this is interesting. This is the MOVE index, which is basically confirming what I'm saying. The market is seeing very, very little likelihood of big moves in bonds in the short term. If we start breaking this 82 level that we haven't broken for years, it seems, going back to 2022, we could easily go down to 51. And that to me says that the bond market is seeing a longer period of stability with nothing really moving. Even something like 2s10s, I really doubt that it can really go anywhere beyond this -11, -12. By that time, the 200-day moving average will have caught up, and I really don't see a negative curve. I don't see 2s10s going negative through zero. It just doesn't make any sense to me, because the Fed, if it saw that, it would take it as an opportunity to cut. So to me, -12 is just about as far as it can go, which also tells me that the 10-year can't really go that much further to the downside in yield, and that everything is now going to be stuck and highly technical. And that's probably the stuff that's easiest to trade, the highly technical markets that only move 3, 4, 5 basis points at the time. And my guess is that is the period that we are entering. The one block that is likely to cut rates even without the Fed, and the Fed being on pause for however long, is certainly the EU. What do I think about Schatz? I love to see Schatz go worse through this 224 to 233 level. I think buying there and buying a whole load of call spreads is really a gift. I think that the risk in the Schatz is very low, and I think that the risk in the bobble is also very low. If we can see some kind of retracement to these levels, 237, I will be a major buyer. I think the risk in the EU is that the negotiations with Trump go very badly, and that there are very high tariffs imposed on their goods. That to me is the risk, and therefore that brings almost instant deflation to the Euro bloc, and you get a lot of cuts from the ECB. And therefore I would anticipate that at some stage this year the bobble is trading below 187. I think the ECB is going to have to cut all the way down to 1% or something like that. That is what I feel is the likelier path, and therefore I will definitely be a buyer whenever we get to these kinds of levels around the 234 or 245 level. I would be buying a whole load of 3 to 6 month call spreads. In terms of differentials, as you can see, this is 2s, Germany, US. Really did nothing last week, and it's trading sideways in this range. Anywhere near this 193 level, I think the risk reward is you buy it and it goes higher. That is the risk reward, and you can see what it did when there are periods when something fundamental happens. I think a 20% tariff on all EU goods, if it were to happen, is going to have one of these effects. The EU is going to have to cut, as an exporting bloc, it would have to cut rates a lot to avoid recession, I think. And I think a really deep recession as well. So that is what I think the fundamentals say. The fundamentals say that at that level, you really have to buy Schatz. I wouldn't be looking for the spread, to trade the spread, but would be really looking to buy calls in Schatz and 3 to 6 month calls, because when these moves start, they tend to last at least 2 or 3 months. So that is what I'll be looking to do, and what makes fundamental sense coupled with technicals. What was interesting last week was that as soon as Trump mentioned a peace deal for Ukraine, the euro rallied. And that is understandable. The euro should rally on that in the short term. There's a big difference between the first reaction and the later reaction. Now, if the start of a war is inflationary, and wars are inflationary, then the end of a war has to be deflationary by definition. So you will get a peace dividend, and that will mean, in how will this peace dividend occur? Well, lower energy prices is one way. Lower energy prices is deflationary for Europe. So if you get lower energy prices in Europe, you will get an expansion in margins, right? Because firms will be paying less to produce, and that is why you're getting this big rally in the stocks. But also it means that eventually the ECB can cut more, right? And that sort of harks back to what I've just been saying about the Schatz. To me, it makes perfect sense that at some stage the Schatz just flies, because the European economy is so damn weak that it makes sense to me that the first to cut, and cut deeply on an inflation picture which goes below target, is the ECB. But the first reaction in the euro is higher, and it's higher on everything, including the crosses. So would I be surprised to see this 105.25 level break at some stage over the course of the next couple of weeks as the talks on Ukraine start coming out? No, I wouldn't be. But as soon as we get to these kind of levels, I am a big seller of euros, because the second iteration of this is actually one which means that the ECB cuts a lot, and then we get the euro coming back to the lows and testing the lows. As you can see on the weeklies, this is going to take quite some time. But I think any time that it gets up to 107.25 over the course of the next who knows what, you need to buy a hell of a lot of put spreads, because the next move is a move down. At the moment, we have several weeks of sideways to up, and then the next move is down, which tells me that the Schatz might not do anything for a month or two, just like the 2-year note is not going to do anything for a month or two. But when it will move a lot. And what makes me think that the euro can achieve that 107 and a quarter, 107 and a half level over time, not next week by any stretch of the imagination, is that that is actually 50% retracement of this whole move up. Would love to see it. It's going to take weeks and weeks. So that's 105.20. In the meantime, we have support at 106.25, and I think next week 106.25 or 106.35, which is the 0.382, is going to hold it for bounces. But I think from now on, bounces are sells. I don't think that the dollar can gain any immediate strength, because there's just nothing for it to have that strength. As I showed you, the twos have actually moved in, so that is actually dollar bearish, and the likelihood of the short end in the US market being able to give any support to the dollar is also not great. You're looking for the short end of the euro to move a lot, and that's not going to happen yet. So to me, this is stuck. This is more likely over time to, every time it gets up here to 107.50, it's a sell, and over time it's more likely to come down to 105.20, which is the 50% retracement. It's not going to be a fast move, because all the interest rate differentials are in the dollar's favor. So you need to have a reason to sell dollars, and the reasons are going to come slowly. It's not going to be a fast move. Gold got thumped on Friday, but that is simply because it gets to these monthly Bollingers and it just comes back. And every time it gets to the monthly Bollingers or through it, it comes back. It's overbought, and it's going too fast. And even it was over the weekly Bollinger and the monthly Bollinger, and it's coming back, and basically it's doing what the DXY is doing, just a bit less so, because bonds are unlikely to go anywhere. And therefore, where would I buy it first? 28.37 is the first 0.382, and then 27.96. I don't think it's likely to make very high, very rapid moves to the upside, because there's just no reason with it, with the dollar being weaker at the moment. But I think that 27.96 is doable, not over the probably next week, but if you see that, it's a good risk reward for call spreads, and anywhere between 28.37 and 27.96 is a decent level for call spreads. If you believe in Trump's drill baby drill, you don't really believe in this GSG being able to break through 22.93. I think that is a very, very important level where we've been basically within since, best part of 2.5 years. If we start breaking through and we start moving this 200-day moving average with a positive slope, that would actually be quite worrying for any bondholders, because it just means that the commodity complex led by oil is starting to move up, while Trump wants it to move down, Besson wants it to move down, and it's one of the key tenets of how they're going to manage the economy. If they can't keep oil down with, a deal on Ukraine, if they do it, with the Saudis helping, if they do it, with deregulation enabling the drill baby drill, then what are we talking about? It just seems to me that if this starts breaking up and you get, let's say, 2 weekly closes, and let's see if I can change that to 1 week, and we start getting 2 weekly closes above, then we are really talking about another increase in prices. If commodity prices go 10%, and that's an easy 10% up to here, then what are we really talking about in terms of the deflation? Nothing really makes sense if that were to happen, right? And that's why I think it's such an important level to watch. And if we start getting weekly closes above, then we know that something is changing. I want to start the equity review actually with volatility, because this is not what the start of a risk-off looks like. We are basically unable to hold anywhere near the 20s, and that to me means that we go and retest the low in volatility, which basically means that we are in a period at worst of stability and at best of buy the dip. And this, it just takes time for this to trade around here before it can go higher. So I think any kind of risk-off move is delayed for a while. Whatever the fundamental narrative might be, whatever the macro narrative could be, it's not being supported by the markets. I think that we break these levels and we go down to 13 quite easily, and that to me says that the market still slowly trundles on its merry way, unfortunately. Absolutely no indication in the charts that we're about to turn. As you can see, the highest weekly close previously was 61.01, and we closed higher. The natural resistance is going to be at the weekly Bollinger Band, which will be 61.80, 61.90, something like that next week. Holiday shortened week. As you can see, we are unlikely to make headway quickly, but any kind of dip is well supported. Every time we get to the moving average, there's support. So, and they've all turned up again, and whether that is the INX or whether it's NDX, like here, you can see that 22,096 was the previous high close, and we are through it by pennies, but we are through it. This kind of pattern is not bearish. Therefore, everything tells me that we are continuing in a buy the dip market. Every time it dips to these moving averages, the market will get bought again. It is what it is. Where is the resistance? Well, here we're going to have 22,300, 22,400 for the highs of the Bollingers. It's not really going to go through it by much, but you can see how the monthlies are just so nice. You know, every time it comes down to the moving average, it just bounces. It's still in an uptrend, and I don't see any point in fighting it. I'm not going to start fighting it until I see some signs of technical reversal. I might like my narrative. I might like that, you know, I think that I know what the consequences of Doge and the budget deficit coming down and the lack of growth are. But until the market agrees with me, I'm just not going to do anything. If there's one market which is begging for cool substitution, it's the stocks. It's above the monthly and it's above the weekly Bollingers, and yes, the target from this is still quite a bit higher, but I think it's going to be volatile. I think it's going to have some very, very nasty setbacks as various pieces of news about tariffs and or about the peace dividend with Ukraine come out. It's going to have some very nasty falls. And if you hold calls as opposed to the contract itself, then you can decide if you want to swap back to the contract and not be stopped out on some very nasty moves down. And I think the first support level is going to be this 5,400 level. But again, any kind of headline from Trump on tariffs against the EU or about Ukraine, it's just going to get reversed very, very quickly, and you're going to be sucking wind on 100 points for no reason whatsoever. I think volatility is cheap, and you definitely want to sell this and buy calls, i.e. call substitution. In summary, I think volatility next week is going to be low, and until there are any signs that we are in a period of risk off, I think that the short end of the bond market is just best avoided. It just doesn't make any sense to buy stuff which is below general collateral when the Fed is going to be on hold for a protracted period of time. Eventually you get the number that knocks it right back and you've lost everything that you've made over the course of weeks. So that makes absolutely no sense to me. I don't think the yield curve flattens much more because I don't think there's much data that's going to allow it. And therefore I think that all the yield curve is going to have a very quiet time for for a bit. And that is why you have Move trading at the lows and threatening to break the lows. Well, if Move threatens to break the lows, and I think it probably will, then you get volatility in SPX not doing very much, and that is probably enough to make everything just trend higher slowly. Trend is probably the wrong word, it just bores you to death, and every time it drops 20 ticks people buy it, and that's that. So it is what it is. Our macro narrative might be prescient for 6 weeks time, 8 weeks time, but it's not at the moment, and therefore you just have to stick to your knitting until the technicals tell you that things are changing. Thank you very much indeed. Have a wonderful President's Day weekend. Tweet you tomorrow.